The power of reaching $100,000, unlocking capital scaling and compound interest. Reaching a net worth of $100,000 is often seen as a pivotal milestone in wealth building. This financial threshold represents not just a significant amount of money, but a critical transition in one's financial journey. The path to $100,000 typically requires discipline, savings, and a focus on smart investments. However, after reaching this level, the dynamics of wealth growth change and wealth accumulation tends to accelerate. Understanding this shift is crucial to making the most of this milestone. Concepts like capital scaling and compound interest become increasingly important, enabling individuals to leverage their growing net worth for even greater returns. Capital scaling. The concept of leveraging existing wealth. Capital scaling refers to the ability to use existing wealth to generate more wealth. In simple terms, once an individual has accumulated a certain amount of capital, say $100,000, they have access to more lucrative investment opportunities that were previously out of reach. This principle is crucial because it allows individuals to amplify their returns and reinvest profits, which can lead to exponential growth. Let's explore this with a practical example. Example: real estate investment. Once an investor has saved $100,000, they might decide to enter the real estate market. With this amount of capital, they could put a 20% down payment on a $500,000 property. Assuming the property appreciates by 3% annually, this would mean the property value increases by $15,000 in the first year. Here's where capital scaling comes into play. Unlike a smaller investment, the larger sum allows for the possibility of higher returns. Additionally, real estate often involves leveraging borrowed money. By using mortgage financing, investors can magnify their potential returns because they are not using all of their own capital. For instance, if the investor put down $100,000 on a property, they might borrow the remaining $400,000. If the property appreciates by 3%, the return on the investor's $100,000 initial investment is $15,000. This represents a 15% return on the down payment, whereas if they had invested $100,000 in the stock market and experienced a similar 3% return, they would have earned just $3,000, far less. This example illustrates how capital scaling allows for a higher return relative to the amount invested, especially when you can leverage debt such as a mortgage to increase your buying power. Example: stock market investments. Similarly, when an individual has $100,000, they can also begin investing in diversified portfolios or individual stocks. With this amount of capital, they can spread their investment across various assets, taking advantage of economies of scale in terms of transaction costs and access to institutional-grade investment opportunities. For example, an investor with $100,000 can invest in exchange-traded funds or ETFs or mutual funds that track large market indices, such as the S&P 500, which has historically returned an average of about 8 to 10% per year over the long term. Let's say the investor allocates the full $100,000 into an S&P 500 index fund. Over a year, if the market appreciates by 8%, the investor's capital would grow to $108,000, an 8% return on the entire investment. While this may seem modest, this is the power of capital scaling in the stock market. Larger sums of money allow individuals to make substantial returns over time, even in relatively stable markets. Perhaps the most powerful force in wealth building is compound interest, which refers to the process where the interest earned on an investment is reinvested, allowing the investment to grow exponentially over time. This principle applies to both simple interest and compound interest, but the real magic happens with compound interest, as it allows you to earn interest on your initial investment and the interest that has already accumulated. Let's break down the effect of compound interest with a basic example. Assume an investor starts with $10,000 in a savings account that earns an annual 5% compound interest rate. In the first year, the interest earned would be $500, 5% of $10,000. In the second year, however, the interest will be calculated on $10,500, the original $10,000 plus the interest from the previous year. So, in the second year, the interest would be $525, not just $500. The longer you leave your money invested, the more powerful the effect of compound interest becomes. Over the span of 30 years, an initial investment of $10,000 would grow to over $43,000 at a 5% annual return. This demonstrates the compounding effect, where you earn interest on your interest, leading to greater growth over time. Now, imagine you're starting with $100,000 instead of $10,000. Let's say you invest this amount in a diversified portfolio that returns 7% per year on average. Year 1, $100,000 grows to $107,000. Year 2, $107,000 grows to $114,490. Year 3, $114,490 grows to $122,504. And so on. Over 30 years, this same $100,000 investment would grow to a total of $761,225, assuming the same 7% return. That's a gain of over $660,000 from compounding alone. This is the power of starting early and allowing time to work its magic. Once you have reached the $100,000 mark, both capital scaling and compound interest start to work synergistically. The larger your capital base, the more significant the effects of compounding become. Additionally, the ability to leverage your wealth for higher return investments, such as in real estate or higher risk asset classes, can further accelerate growth. The impact of $100,000 on investment strategies. Let's say an individual has reached $100,000 and decides to take on a real estate investment. They purchase a rental property with a 20% down payment, using $100,000 for the down payment on a $500,000 property. They secure a mortgage at 4% interest and expect a 5% annual appreciation in the property's value. Initial investment, $100,000. Property value growth, 5% annual appreciation. Mortgage interest, 4% annual mortgage payment. If the property appreciates by 5% in year 1, the value of the property would increase by $25,000. The investor gains $25,000, but because they only invested $100,000 as a down payment, this represents a 25% return on their initial investment. This rate of return would be extremely difficult to achieve with safer investment vehicles like bonds or savings accounts. But leveraging capital through real estate allows investors to access much higher returns. The role of small increases in contributions. While achieving a net worth of $100,000 is a significant achievement in itself, it's important to remember that small increases in monthly contributions can have an outsized impact when combined with the power of compound interest. For example, increasing your monthly investment by $500 a month, starting from $100,000, can add $180,000 to your portfolio over 20 years, assuming an average annual return of 7%. Initial investment, $100,000. Monthly contribution, $500. Annual return, 7%. Time horizon, 20 years. Using a compound interest calculator, the total value of your investment at the end of 20 years would be approximately $625,000, substantially more than if you had only relied on the original $100,000 investment. Overcoming challenges to wealth building. While the concept of accelerating wealth after reaching the $100,000 mark is compelling, it's important to recognize that getting to this point may require overcoming several financial hurdles. Many individuals face challenges such as fear of market volatility. A common fear for new investors, especially during periods of economic uncertainty, is the fear of losing their money in the market. However, with a long-term perspective, the stock market has historically shown an upward trend. Lack of financial knowledge. Many individuals do not know where or how to start investing. Simple strategies like setting up automatic contributions to tax-advantaged accounts like IRAs or 401ks, or working with a financial advisor can help overcome this barrier. Unlocking exponential wealth growth after $100,000. Reaching a net worth of $100,000 is a powerful moment in your financial journey. At this stage, the power of capital scaling and compound interest work together to create an environment where wealth growth can accelerate dramatically. By leveraging existing wealth for larger investments and allowing your money to compound over time, individuals can unlock a world of financial opportunities. With discipline, strategic investing, and a long-term perspective, you can continue to grow your wealth well beyond the $100,000 milestone. Remember, building wealth is a process that requires patience, knowledge, and a willingness to take calculated risks. By focusing on compounding your returns and scaling your capital, you can set yourself on a path toward financial independence and long-term success. Additional investment options for accelerating wealth building. Once you've reached the $100,000 mark, the world of investment opportunities truly opens up. Beyond real estate and stocks, there are several other asset classes and strategies that can amplify wealth accumulation. By diversifying into different types of investments, you can mitigate risk and take advantage of new growth opportunities. Peer-to-peer lending, or P2P. Peer-to-peer lending platforms like Lending Club and Prosper allow you to lend money directly to individuals or small businesses in exchange for interest payments. This type of investment can yield high returns, with interest rates typically ranging from 5% to 36%, depending on the risk level of the borrower. While P2P lending can offer higher returns than traditional savings accounts or bonds, it also comes with its risks. Borrowers may default, and the market is sensitive to economic changes. However, P2P lending is an appealing option for those seeking to diversify their portfolios beyond conventional stocks and bonds. For example, if you lend $10,000 on a P2P platform and the average interest rate is 12%, you could earn $1,200 annually over 5 years. Without considering defaults or fees, your $10,000 could generate $6,000 in interest, bringing the total to $16,000. Investing in commodities like gold, silver, or even oil can be a great hedge against inflation and market volatility. Commodities tend to do well during times of economic uncertainty, or when inflation is rising, because they represent tangible assets that are not subject to the same risks as currencies or stocks. Gold has long been a safe haven for investors seeking stability during market downturns. For example, from 2000 to 2012, the price of gold increased from about $300 per ounce to over $1,700 per ounce, offering investors significant gains. Oil can be volatile but has offered high returns in certain periods, especially when demand spikes or supply is disrupted. Investors can gain exposure to commodities through ETFs, mutual funds, or even directly by purchasing physical assets like gold bars. Another popular method is through commodity futures contracts, but this requires advanced knowledge and experience. In 2020, during the COVID-19 pandemic, the price of gold surged above $2,000 per ounce, peaking as investors flocked to safe haven assets. An investment of $10,000 in gold at that time could have potentially grown by 20% or more over the next year, depending on market conditions. Cryptocurrencies like Bitcoin, Ethereum, and Solana have grown in popularity as alternative investments in recent years. These digital currencies have seen astronomical gains in the past decade, with Bitcoin increasing in value from under $1,000 in 2017 to over $60,000 per coin in 2021. While the volatility of cryptocurrencies presents substantial risks, especially in the short term, they also present significant opportunities for long-term investors willing to accept the high risk. The key to investing in cryptocurrency is to approach it as a high-risk, high-reward strategy. A small allocation of your portfolio, say 5 to 10%, can expose you to the potential upside while limiting the overall risk. If you had invested $10,000 in Bitcoin at the beginning of 2020, when it was priced at about $7,000 per coin, you would have been able to purchase roughly 1.43 BTC. By the end of 2021, when Bitcoin's price surpassed $60,000, that $10,000 investment could have been worth more than $85,000. However, it's crucial to note that cryptocurrencies are highly volatile, and their value can drop just as quickly as it rises. Therefore, this asset class requires thorough research and a high tolerance for risk. If you have a higher risk tolerance and are looking for more innovative investment opportunities, consider venture capital or angel investing. This involves investing in startups or early-stage companies in exchange for equity or ownership in the business. The potential for high returns exists if the company becomes successful and grows rapidly. Angel investing can be done through online platforms such as AngelList and Seed Invest, which allow accredited investors to find and fund startups. While the risks are higher than traditional stocks or bonds, a successful investment in a startup can result in 10 times to 100 times returns. Let's say you invest $50,000 in an early-stage tech startup. If the startup grows rapidly and is later acquired or goes public at a 10 times multiple, your $50,000 could turn into $500,000. However, this is an extremely high-risk investment, as most startups fail, so it's essential to diversify your investments and be selective. Resources for learning, successful investors, investing styles, and models. To become a more effective investor, it's essential to learn from those who have already achieved significant success. Below are some well-known investors, along with their strategies and models, which can help guide your own investing journey. Warren Buffett. Value investing. Warren Buffett, the CEO of Berkshire Hathaway, is considered one of the greatest investors of all time. His investment philosophy revolves around value investing, which involves buying stocks that are undervalued by the market but have strong potential for long-term growth. Buffett looks for businesses with a competitive advantage, a strong management team, and a consistent earnings record. Buffett's approach to investing is famously conservative. He advocates for buying stocks of high-quality companies and holding them for the long term, often for decades. One of his most famous quotes is, "Our favorite holding period is forever." Books and Resources, The Intelligent Investor by Benjamin Graham, a must-read for anyone interested in value investing. Buffett himself has called this the best investing book ever written. Also, Berkshire Hathaway Annual Letters. Buffett's letters to shareholders are filled with wisdom on investing and business principles. Peter Lynch is another legendary investor, best known for managing the Fidelity Magellan Fund from 1977 to 1990, achieving an annual average return of 29.2%. Lynch focused on growth investing, searching for companies with above-average growth potential. His investment philosophy is encapsulated in the idea of investing in what you know. He often emphasized that individual investors could spot investment opportunities through their everyday experiences. Lynch also looked for companies with strong earnings growth, low debt, and a competitive edge. Books, Resources, One Up on Wall Street by Peter Lynch. This book offers insight into how Lynch discovered some of his most successful investments and how ordinary investors can emulate his strategy. Beating the Street by Peter Lynch. Another essential read for anyone wanting to understand his approach to finding promising stocks. Ray Dalio is the founder of Bridgewater Associates, the world's largest hedge fund. Dalio's investment approach focuses on understanding global economic trends and using this knowledge to predict market movements. He's known for his principles of investing, which revolve around understanding the interplay of macroeconomic factors like interest rates, inflation, and geopolitics, and using that to build diversified portfolios. Dalio uses risk parity strategies, which involve balancing risk across different asset classes, stocks, bonds, commodities, in a way that maximizes return while minimizing overall portfolio volatility. Books, Resources, Principles, Life and Work by Ray Dalio. A comprehensive guide to Dalio's life principles, which are heavily influenced by his approach to investing. Bridgewater Associates Research. Bridgewater's website and Dalio's writings offer deep insights into economic theory and market analysis. John Bogle was the founder of Vanguard Group and a pioneer of index investing. His investment strategy is centered around investing in low-cost index funds that track the overall market. The core principle of this strategy is that most active fund managers fail to outperform the market over the long term, and low-cost passive investing is the most effective way to achieve market returns. Bogle is a proponent of buy and hold investing, and he believes that investors should focus on the long term rather than short-term market fluctuations. His approach is simple. Invest in broad market, low-cost index funds and let compounding work over time. Books, Resources, The Little Book of Common Sense Investing by John Bogle. This book explains the basics of index investing and why it's the most reliable strategy for most investors. Vanguard's website. Vanguard offers a wealth of resources on index funds, asset allocation, and personal finance. Reaching a net worth of $100,000 is a major accomplishment and provides a strong foundation for further wealth accumulation. However, to accelerate growth beyond that point, it's essential to diversify into different asset classes like peer-to-peer lending, commodities, cryptocurrency, or even venture capital. Understanding the principles of capital scaling and compound interest is key to leveraging these new opportunities effectively. Furthermore, learning from experienced investors like Warren Buffett, Peter Lynch, Ray Dalio, and John Bogle can provide valuable insights into different investment styles, helping you refine your own approach. Whether you prefer value investing, growth investing, or passive index strategies, there are countless resources available to guide you on your wealth-building journey. Remember, building wealth is a continuous learning process. And by consistently researching, diversifying your investments, and applying sound principles, you can steadily increase your net worth and create a more secure financial future.